Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik. Today it is my pleasure and a privilege to welcome Matt Calhoun. Hi, Matt.
Thanks, Mike. Thanks for having me.
Thanks for coming. Matt hails, is the director of, real estate investments, right? Alternative investments.
Yeah.
At the Midland Trust. And tell us a little bit about you, Matt, where you live, what kind of family, and then we'll talk a little bit about Midland Trust, how is it different from other self-directed IRA custodian, and we'll jump into some advanced topics. So tell us a little bit about Matt.
Yeah. So I'm here in Fort Myers, Florida. So it's actually where our company is based. Got into the industry from actually real estate investing myself. So worked in the financial services space, started picking up some duplexes here and there. And it's really hard to get excited about mutual funds when this real estate investment exists. So I found out about self-directed IRAs. It's just a kind of a combination of financial services and real estate investing. Still doing the real estate investing on the side, but my day-to-day with Midland is to walk investors who want to diversify their retirement funds, so old 401ks or these IRAs that invest in the stock market, and they now want to deploy those into different asset classes. And most of my conversations revolve around real estate, directly, funds, different syndications, and just really diversifying those assets, those retirement portfolios into those asset classes. So beyond real estate investing, Midland, I do have 2 kids at home, so they keep me busy. Between basically, as many people know, real estate isn't always passive. So that's a full-time job, and Midland keeps me busy as well. So a lot of hours into those things.
Thanks for the introduction, and that's wonderful. Family is number one. I was hoping to start with the family, but you jumped straight into the Midland Trust. But it's great that you have 2 kids, and that's God bless.
Thanks.
The left coast of Florida is pretty cool. You get a little bit warmer water, and you don't get as many hurricanes. At least that's from that perspective.
Yeah, try to avoid those as much as possible. And then you mentioned Midland, so we are a self-directed administrator. We found our niche really in the private equity, the real estate syndication, the real estate fund space. We've tried to specialize in those conversations in those asset classes, just to make the client process smoother in those. It's complicated. We try to make it as turnkey as possible. If somebody has interest, we want to make it easy for them to get those funds into those groups. So
makes a lot of sense. So what's this? Just go to the basics. Not spending too much time on this. But let's just say someone who is been investing for years into self-directed 401k and or self-directed IRA with the Wall Street type of investments, mutual funds, stocks, some Wall Street traded bonds. And let's just say they want to take portion of their portfolio and invest in alternatives into something that real estate specific, real estate funds. We obviously offer funds and syndications, or you're working with other folks. What's the easiest process for them to move the funds and to be available to invest through you? Some folks talked about rollover. Some folks talk about transfer. I certainly believe a transfer is an easier process. Just curious, any quick comments on this?
Yeah, first step is definitely look for a custodian who administers those investments. So, if you have your funds at a big Charles Schwab, a Fidelity, an asset class like that, you may not be able to deploy those in those alternatives. So you'd look for a company like Midland or a self-directed custodian. You're going to open up an account with them, and you're right, transfers are much easier. So if you have an IRA account, that process is just moving funds from one IRA to another. You'll normally be done in as little as a few days, maybe a week. Funds will be there and ready to invest in your alternative. If you have an old 401k, expect that process to take a little bit longer, like 1 to 2 weeks it can take. 401ks are a little bit trickier to get funds out of, or 403bs. This may be a little specific to Midland, but what we do is we try to work with those investments ahead of time to provide the most streamlined process for the investor. So we'll go through, get the subscription documents ahead of time, pre-fill them for the IRA account. Everything that we know we'll fill out, have the investor walk them through basically, hey, this is where you have to fill out things. It's all done by DocuSign. So we really provide just that easy process from this is what I want to invest in. How do I get there? We have a dedicated service team. So you'll have actually one person on our team who's done that investment countless times. They know what they're looking for, and they're there to answer your call and walk you through that process. The funds are then wired to that investment, and your account with Midland then is invested in this alternative investment, and you're really going from there. Like I said, some of those things are specific to Midland, but some of those are general across self-directed IRAs.
Yeah, I appreciate that, and that's a great way to describe it. And I went through this process many years ago, and I remember the rollover is always harder, and 401k is always harder. So, folks that are thinking about doing this, if they left the previous employer, perhaps it's easier to move the money to self-directed IRA custodian sooner rather than later. It all also depends, obviously, on individual selection. Some folks still want to stay somewhat invested in stock markets, and some folks are sick and tired of a stock market and they would like to take further control and invest into things they understand. So now let's jump into a little bit more advanced topics.
Yeah.
So most investors who do this want to grow their Roth IRA, and kind of interesting that for years the Roth component of 401k case have been scarce. There are limitations on Roth IRA in contributions as well. So how do folks go through traditional to Roth IRA conversion? Do you see it happening often? Do you see folks converting more in cash, or do you see them converting, they will make an investment and I'll convert with an investment? Typically, sometimes you can get a discount on your converted value.
Yeah, no, you're right. I mean, most people I talk to on a daily basis, they hear Roth, they're like, man, I wish I could have that. But for one reason or another, they contributed to a pre-tax plan. They're unable to contribute to a Roth because their income limits are too high. The conversion does give them that option of getting some of those pre-tax dollars to a Roth account. You pay a tax now, so it's really a strategic play. You think, okay, maybe my income's down a little bit this year, or maybe I just want to pay the taxes because I see a lot of advantage in this investment. I think if I'm going to grow this investment, I want to grow it tax-free, so I can get a larger sum when I retire. As far as what I see probably more cash. People think ahead of time, okay, I'm going to convert this to cash. It's easier to move funds from a traditional IRA to a Roth IRA in cash, but not saying you can't do what we call an in-kind contribution. So as your investment already is invested, you already hold investment in a tempo fund or a different group, you can actually convert that to a Roth account. We get a value of what that conversion is. You have a tax implication that we file for you. But then that Roth account holds that investment. It's growing tax deferred, just like it was before. But once you start taking those withdrawals, tax free, which is a large benefit to a lot of people.
Yeah, I appreciate that explanation. Makes a lot of sense. And I can tell you this, from years ago, I converted from traditional to Roth in cash. And they tell you the story, hey, converted on January 2nd, so you have a free year of not paying taxes.
Yeah,
that gives you very little flexibility because you don't know what the year is going to look like. If you have a great year, it doesn't really help because you're in the highest tax bracket, and also you have no ability to get any discount to the cash if you invested into something that can be valued less than you invested in cash, which some folks have done. We've seen quite a bit of folks do that. It's a very powerful way to get a somewhat of a discount on the tax liability versus the cash. But it's easier to do in cash, so for sure, that's the good old classic way.
It is. I would say we do majority of our conversions actually in December, for the reason you mentioned. Like by December, I know what I made, and I can kind of play that game. Okay, can I max out a tax bracket? Because I should say, when you do that in-kind conversion as well, you don't have to do all of it. So it's not, I have a $50,000 investment, I have to take a $50,000 conversion, tax it. If you want to do 10 a year, we're okay with that as a custodian. We can do 10 every year, so you limit your taxes, and then over a 5-year period, you move that $50,000 investment to Roth. So there's definitely a lot of strategies involved with a Roth conversion that, like you said, sometimes doing it in January may not be the best option. I think December is the most popular, and then probably April, because people are contribution minded at that time of year. But yeah, I like to see a December. The other option for an in-kind is we can do a December and a January. You did some in December for this example, it'd be 2023. Maybe January 1st, we do another portion for 2024. So you can kind of knock it all out at once, but you did your conversion for 2 years too. So a lot of different strategies between the custodian, a CPA, or a financial advisor. There's a good plan to be able to convert those assets to Roth.
Yeah, I appreciate that. Of course, that flexibility helps folks with tax planning.
Yes.
But I assume every time there's a conversion, of course, they need to send you a valuation letter if it's in kind or in invested into a fund or syndication. So I assume that's the process, right? You need the valuation letter. You don't go through the process of how much it's worth. You just document. As a custodian, that's the simplest and easiest way. Is your job is to document what the conversion look like.
Yeah, as a custodian, we do need a valuation. Conveniently, with that December, a lot of people are getting their end of year values started around that time, so that helps as well. But yes, correct. As a custodian, we know how much you're going to contribute or convert, and then we'll need a valuation on the asset as of that date as well.
Yeah, I appreciate that. And for most folks, they should obviously consult with with their own CPA professional to understand what are their individual circumstances. And in general, conversion makes sense. It's one of the few investments that are tax free forever, in essence. Like a Roth IRA, in theory, you can grow to pretty good size and never pay taxes. There are very, very few other things that IRS code allows.
Correct.
So it's a tremendous asset if you can grow it at a pretty good pace. So I like to put it this way: $1 in cash versus $1 in traditional IRA versus $1 in a Roth IRA. In my view, depending on how many years you have left, right? $1 in Roth could be worth on a long-term basis. You could probably say $3-4 versus cash, right? Because of all the compounding, if you have long enough time. And if it's versus $1 in traditional, it's still worth more than traditional because you don't have to pay taxes on the income.
Sure.
So maybe kind of a $3-4 or value of Roth versus $2 worth of traditional versus $1 worth of cash. So for folks who are doing this, it's that tax planning exercise with their CPA. Any other quick thoughts on this, and then we'll jump to another advanced topic.
No, it's really good points. I always like to think of it as, we're diversifying our investments, but what this gives you the ability to do is diversify your tax exposure. So there's places for traditional and they're a great tool as well. But having the buckets to pull from, like in retirement, if I know I have a bucket of tax-free money, I have some pre-tax, there's a lot of good planning you can do in retirement if you have those options to you. So no, we can definitely move on, but it's great thoughts.
Yeah, makes sense. The other topic that does come up, and we are in the alternative space, and I'm just curious, sort of, if you hear about this. A lot of folks are concerned about UBIT, unrelated business income tax, or sometimes it's called UBTI, unrelated business taxable income, and depending on how you look at it, but it's the same, more or less. Same. And it does arise from certain circumstances. Just explain to folks, and also explain what actual risks on them. As I see this picture all the time, not all the time, but sufficiently often. And so folks have not known about this. They've made investments into leveraged deals. They bought a turnkey property with their self-directed IRA.
Sure.
And then they start worrying about what happens now. I didn't pay taxes for the last 5 years, even though I was supposed to file because it's theoretically leveraged in the deal. So what happens? Let's just describe the basic condition when UBTI is a little bit of a concern to what do folks do about it?
I'll just kind of go a little bit more. So the leverage is a big thing. It can be certain types of income, active income versus passive. And it does complicate it when you're thinking, I'm doing a retirement investment, no taxes, it's all deferred. These taxes can be part of certain types of investments. It's a factor. You should definitely consider it and know if it's going to be, at play in the investment you choose. What that looks like in practice, if that is something that your investment is subject to, your retirement account essentially files its own tax return. So separate from you personally, it files a tax return that says, okay, this amount of income that the IRA account generated is subject to this UBIT tax. You get a first $1,000 for free. So for whatever reason, when they designed the tax code for that, your first $1,000 of income is not subject to that tax. And then after that, there's a certain tax bracket that the IRAs are subject to, close to like trust tax rates is pretty how I compare them. They can be pretty steep at the high end. Now, normally you don't worry about any deductions that come into play with retirement accounts because it doesn't go to the retirement account. Now it does. All of a sudden, it complicates the matters and the fact that I didn't worry about any deductions because I was getting tax deferred income or tax free revenue from this investment. Now I get to factor in all that and offset some of that UBIT tax. So it is a complicated formula. It's something to consider. You can specify your investments around ones that maybe are less subject to UBIT and so on. We can definitely have these conversations. The investment sponsor is also going to be probably aware if they've done investments, if it's been going for a while. They'll know if it's subject to UBIT or not, most likely. But if they've issued a K1, it's part of the line items. So just know it is a factor in certain types of investments. It shouldn't deter you from investments because sometimes the returns, the offsetting, if you have to file a tax return, sure, that's an expense maybe you should just factor in. But investments can definitely still make sense. And if you're still in a Roth account, the net is probably still going to outweigh the expense there.
Yeah, I appreciate that clarification. Of course, at the end of the day, the most important decision is risk reward on the investment. Whether there's some UBIT tax due or not is a secondary consideration, but it's worth talking to a CPA. The other idea that I've seen folks do is set up a blocker C Corp.
Yep.
Which is one of the easiest way to avoid UBIT risk at all. Although it has the corporate tax that the C Corp has to pay, but the structurally its IRA account would own a C Corp and a C Corp would make the investment. So it certainly completely protects against the risk, and it only makes sense in certain size. So for a small investment, it doesn't make any sense.
Sure.
But for a significant investment, it's worth consideration. As it's not a very complicated structure to set up, and it creates that complete shield. And the corporate tax rates, especially on a lower level, are substantially better than the tax rates. So from that perspective, just mentioning this for folks, if they're really concerned about UBIT risk, they should consider setting up a blocker C Corp, again, with a CPA advice, of course.
That's a good strategy. And I've also seen people avoid the UDFI, so the debt leverage on if you're eligible for a solo 401k. Solo 401ks are actually exempt from UDFI. So if you're looking at, I can set up a solo 401k, or I can do an IRA in the same investment. The 401k may be the way to go if that UDFI applies, and it's a good strategy to avoid that as well.
So one of the accounts that you actually allow investors to have is self-directed solo 401k, right?
Yeah. Yep. So that would be someone who owns a business with no full-time employees. There's some exemptions to certain employee types, but you can set up an individual 401k, solo 401k. They're the same, and they have lots of other benefits to them. But one is that they're exempt from the UDFI tax.
But just to clarify, solo 401k, which is what you do, you don't do administration for a group 401k for a small company. You just do a solo 401k as part of your offerings, right?
Correct. Yeah, we only administer solo 401ks or individuals for sole proprietors most of the time. Real estate agents, 1099 employees. If you have a group 401k, you'll look for a different group that's going to do that because they have to have third-party administrators and different types of reporting. So we don't personally do that, but the individual 401ks we do.
Yeah, makes sense. And so how do you differentiate yourself from other IRA custodians? Most folks looking for a white glove service. At the end of the day, in this business, even though the subscription documents are not terribly difficult, terribly complicated, but they're different from what folks are used to. So white glove service helps, and as they have questions, just curious, what are your thoughts on that front?
Yeah, I mean, we've had the benefit of seeing how the process works from other people and being able to adjust our strategy from there. So with Midland specifically, our service works in two ways. We have actually the people side of it. So I mentioned a dedicated service representative. It helps that your dedicated contact, that person you can call directly, you're not calling a 1-800 number, has seen the investment. They've done it with other people before. So they're able to get you from A to B much quicker. They know the investor you're talking about. They know your account. They've spoken to you before. So that personal service really does help. And then integrating our technology into it. That's not just an online portal so you can see statements and see your investment, but we've integrated transfers. So if you've already done a transfer from that way before, we can speed that process up. We already have all that info, the investment, adding additional funds, distributions. So giving our service team basically integrations into the technology, utilizing electronic signatures or anything else that basically makes that process easier. Last thing we want you to do is have to fax a form in, talk to somebody who's doesn't know who you are, doesn't know your account, being able to basically give, like you said, that white glove service. These are complicated things, and some people, this is their savings, their life savings. Some of the bigger assets are their retirement accounts. So we make sure that feels important, that we know it's important to them as well, and getting them there. The educational side's great as well. Being able to provide, right now, I think we're doing weekly or bi-weekly webinars on different asset classes. So you may not have interest in all of them, but it just gives you the idea of not only knowing different investment classes, but also what can I do with this retirement account as new laws pass, Roth conversions, just different things that we can provide our investors to, help them be, I guess, better retirement account investors as well. So at Midland, that's kind of what we've put ourselves forward to make that, service is kind of our cornerstone of our company.
Yeah, makes sense. And that's important. At the end of the day, that's the biggest differentiator. I'm just curious. I have kind of a super advanced question, and I don't know if you've seen this,
Sure.
but we, as kind of fund managers and syndication managers, we have a lot of folks that have invested with us. And one of the challenges, not challenges, but one of the things that we don't particularly like to do, and it happens. So folks go through transfers. It's exactly what we just talked about. They want to convert traditional to Roth.
Yeah.
So they need titling to be changed on the investment. And we've also seen the same thing that have nothing to do with IRAs. It has to do with individual owning an investment and going to an LLC,
Sure.
or going into a family trust. So you see quite a bit of transfers to the family trust, especially when folks are, in their retirement years, and they get advice from CPA that they need the title to be moved to a trust. So we've seen enough of that.
Sure.
And the following thought has crossed the mind. I haven't seen too much of it, but it would work the same way. So I've seen individual investment being moved to an LLC or a trust to avoid probate. God forbid something happens, right? The self-directed IRA, we have same issue. You have traditional to Roth, and it's more paperwork that has to be done. But the same technique can be used. And again, my question to you, if you've seen it, just curious. So you can have a self-directed IRA. Instead of owning an investment directly, could own an investment through a trust. In other words, just whatever the trust can be formed, and the trust beneficiary is an IRA, and then the trustee facilitates the investment into whatever, and it helps quite a bit when there are sort of folks that actually have an attorney as a trustee, but the investment goes into a fund or syndication. So whenever they have to convert, they can just convert by virtue of moving beneficiary within a trust from traditional to Roth, instead of kind of reaching out and having us do the transfer paperwork. Have you seen that? I'm just curious, because when I saw this with the individual accounts, but that's a great idea. They can change it, and they can gift it to kids, and they can do things over time. So you can do the same thing within the trust. You can do 10% conversion every year from traditional to Roth, whatever makes sense to them and their CPA.
Yeah, and I'll even open that up to LLCs, like you mentioned as well, because an IRA can actually own an LLC as well, and the LLC can invest. Normally, trusts are transitional with retirement accounts. So, most common way we see that applied is, the client leaves their trust as a beneficiary, they pass away, and it goes to the trust. And sometimes the trust then dictates that gets spread out to different other people's retirement accounts and so on. So sometimes trusts are transitional, but you're correct. Especially from, Tempo side or different sponsors, it does make the administration a little bit easier because that direct entity is not changing.
That's right.
Now the trust documents, the LLC documents, those are probably going to get updated. They are going to get updated. If the LLC is the easier example, if an LLC has the IRA, a traditional IRA as 100% owner, and then we convert half of it that year, now the LLC has a 50% ownership by a traditional IRA and 50%. It doesn't change on your side or the deal, but the LLC documents are going to get updated. If we go back to the trust documents are going to get updated and saying this was a traditional IRA, it is a Roth. So there's still an update that has to be done. That being said, they're not updating all their subscription documents, all the investors. So it probably is easier than going through. So I hope that answers that question. But yeah, it definitely can be done. The direct investor into the fund, can be an entity or a trust.
Yeah, and I appreciate you explaining this and adding the LLC component, which it makes sense.
Sure.
Certainly seen a lot of people owning IRA LLCs, and for the more sophisticated investors, that's actually a preferred way of doing it. For one, it creates anonymity, right? They don't even know. You don't need to have exposure to the exact account name. You just create the LLC, and that's both shields the beneficiaries, and then you can do exactly what you explained. Convert within the entity from traditional to Roth to whatever degree you have to convert, and that whole process becomes a little bit easier. Probably the same documentation for your side, from your side, but from our side, it's simpler and gives a little more flexibility. We certainly prefer when we get an LLC investment instead of traditional IRA, and then this year they only convert 20%, and it becomes more aggravation, and you have to manage now 2 sub accounts. So
the nice thing is we do that on a daily basis. So for us, it's not a big deal. But yeah, we want to make it easier for you as well. So like you mentioned, if the LLC doesn't have to change, it makes your life easier to do what you want to do.
Yeah, I appreciate that. So how would folks get a hold of you if they wanted to learn a little more about Midland Trust? They wanted to potentially move some Wall Street money to alternatives.
Yeah. So I'm available in a lot of different ways. I have my email address, direct phone number. I can give you my direct phone number. It's 239-333-4461. You can call me directly, answer these questions. We can go into in-depth a little bit more about your personal situation. But feel free to email me. Go on our website. You can look at my calendar, book a time. A lot of different ways to get in touch with me. I love having these conversations every day. The website is midlandtrust.com.
Midlandtrust.com. Appreciate that. And thank you, Matt, for coming and sharing your wisdom. And thank you for sharing your phone number. Hopefully you'll get phone calls. So folks wanted to learn a little more about that.
Yeah, perfect.
Thank you again. Have a wonderful day.
You too.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.